Let's just bring in now Todd from FIIG Securities as well, just to add some more to this discussion. Mark, we're just chatting there with John Noonan from Thomson Reuters about the issues emanating out of Spain over the weekend and the reaction on markets. The 10-year Spanish bond yields there going up to 7.3%, record highs there.
Yep.
Where do you see this going? I mean, do you see this continuing on the volatile path that we've been seeing?
Yeah, I think we're wedded to this volatility for a long time, and I think John's right where he makes the point that the political action needs to be taken, and he then consequently makes the other point is it's hard to imagine these people being able to do that. Muddling through has got them through, and they're appealing to their voter base in the form of Merkel into the Germans, saying that, you know, we won't go too far, we won't commit ourselves entirely to a fiscal union, we won't have Eurobonds, when in reality they need to get into a room and be very honest with each other and say, if you don't have some sort of consolidation, this thing will just muddle on for years. When John talks about people buying the bonds, the only people who are buying these bonds are professional investors or the self-interested investors. So it's a circular reference. Ultimately, there's no fresh money going into those assets, because why would you? The volatility is incredible, and you can get better returns and better returns for less volatile performance in other assets. So if you buy US Treasuries at such low rates and they rally again, you get a better return over the short term than trying to hope that the Spanish government will talk to Valencia and get it worked out. It's very hard to invest on that basis.
Mark, yeah, John Noonan from Thomson Reuters. What's happened as well, because of the actions by central banks, particularly the ECB, when they brought rates, or the deposit rate, down to 0%,
yeah,
we're seeing extraordinary amounts of flows going into short-dated, up to 2 years sovereign debt, where we're seeing minus or negative yields in quite a few countries across Europe.
Sure.
Now, this is creating a little bit of dislocation and forcing other investors up the risk curve a little bit, isn't it? I mean,
that's right. I think the investors, if you can imagine, there's a pyramid effect. The investors are investing on behalf of whom? It'll be an institutional pension fund. It'll be the mums and dads, if you follow it very shortly. And at the end of the day, those institutional pension funds need to get a return that people can retire off. And if you have negative yields, they themselves are coming into a great problem. So they're looking for yield, and they're saying, I want a return, but I don't want to invest in a sovereign that's based in Europe. And so these mandates are coming through that are making it very tricky for the managers to be able to get the return that sustains the growth that you need in the retirement dollar. And it's a very big issue. When we're pushing all these rates down, we're saying we want lower rates. The retirees, which are forming a vast percentage of everyone as the populations across the globe start to age, these people are looking for a retirement that they can, you know, travel and have a retirement they imagined they were going to get. And if the returns become 2%, 1%, and they're under inflation, you have a real issue somewhere down the track around not having enough money to retire on.
Well, I suppose for somebody like FIIG, I mean, it makes a very interesting situation where you have the search for yield, so people being forced up the risk curve. So finding high yield in a time where the environment is as risky as it is because of the European situation, and being certain that you're going to get your money back in the search of the higher yield, it's a bit problematic, isn't it?
No, the irony of all ironies is that the Australian market doesn't really, or hasn't really had a bond market before. So in Europe and North America, everyone is an investor, a natural investor, a mum and dad investor will have some equity and will have some debt, whereas in Australia you don't. And so what's happened here at FIIG is that we've been able to access bonds and bring them to the market where 6 and 7% yields for infrastructure bonds. You know, it'll be the defence, housing, building. So it's the Australian government, not the credit, but it's the income coming from rental for an infrastructure asset or Sydney Airport or things like that. So there are a lot of assets in Australia that could do with a bond attached to an equity piece that we are bringing to the clients. So it's actually working out in our favour where people want less volatility. One thing I'd point, John, is Basel III will have a very significant effect on most corporates in Australia, where they can go to the bank and only borrow a certain amount of money, and around the Basel III restrictions, the bank won't be able to lend them any more money. So those people are coming to us as corporates, good quality corporates, saying, what about if I issue a bond? I've never done one before. So in terms of your idea about going up that risk curve, I think we're actually taking people out of the risk of equities and putting them into the more secure senior paper, and it's safer bond.
Mark, just quickly, if we could ask you about expectations then for where rates are going here in Australia. We've got a big week in terms of focus on inflation here. What are your thoughts for CPI on Wednesday, and how do you think the RBA is going to react?
The standard expectation is that the second quarter will be 0.6, and we should see that as a 1.6 year on year. I think the RBA will be looking at all the problems in Europe, and I think it's a very smart RBA at the moment, and though there will be a lot of pressure from everyone to say let's lower rates, let's keep that continuing movement down in rates, the RBA will be looking at how many bullets it has in that gun and whether a 0.25 cut in their rates will in effect change any of the impact of the European changes, any of that volatility that comes into the marketplace. So I think they'll hold as long as they possibly can, but a low CPI will put a lot of pressure on the RBA to make some moves, but I think they'll be reluctant to move wherever possible right now.
Great to get your thoughts, Mark. Thanks so much for joining us today.
Take care.